Peloton's earnings are out, and the market is not very happy with what we heard today. The stock, as I'm recording, is down about 23%. And this is really a mixed bag. There was a little bit better demand for hardware. The app is not taking off like I think I would have hoped in particular. And then the big story was guidance for the rest of fiscal 2024, which ends at the end of June. In particular, that Peloton is not going to be free cash flow positive this year. That was a goal that management had set. They said they're going to hit that in Q4, but that has kind of been pushed back. There are some reasons for this, and there's some nuance. So I want to go through the earnings report, what I took out of the conference call as well, cover all things Peloton because this is a stock that I own, but I haven't been adding to it because I'm a little bit uncertain about what the upside and the future of the company is. My name is Travis Hoyam. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they're going to give you their top 10 stocks to buy right now. Here's just a quick look at the stock as I'm recording. Down about 23%, like I said, and just kind of dropped like a rock the first hour and a half of trading. But let's start with this shareholder letter. And this is something that Peloton sends out every quarter. CEO Barry McCarthy, I think, does a nice job talking about the business and acknowledging what is going well and what went poorly. I'm going to go through a couple of those things because I think one of the things you want to hear from a management team is that, one, they understand the business, and two, they're doing things from a strategic perspective that are going to improve the business long term, and they're learning from mistakes. It's not very usual for management teams to admit that they got things wrong, but there are some things that they went through here. Said that they were outperforming in the connected fitness market. This is one of the reasons that I have liked Peloton for about the last year, is you're starting to see that Peloton is taking a lead versus its competitors in the market. Companies like Bowflex, Beachbody, Equinox had some connected fitness products. All of these other companies are kind of falling by the wayside. Their financials just look terrible right now. Some of them are getting out of the business, like Lululemon did with Mirror when they partnered with Peloton. So if this is going to be a winner-take-all market, it looks like Peloton is going to win the market. The question is the market big enough to even care about winning? And that's something I don't think we got a full answer on today. Here's where we talked about some of the things that didn't work. And this was, I think, a nice headline and press release for Peloton when they did these co-branded bikes with the University of Michigan. The thought was you could get students, alumni, boosters excited about branding for a certain Peloton, with their favorite team on the bike, but it didn't go well. And so they basically said, hey, we're not going to do this anymore. They also acknowledged that member support, which is basically like customer service for Peloton, was not as good as it needed to be, in particular in the holiday quarter. So did a lot of things on the back end. And again, this is not the kind of things we're going to see as investors, but did a lot of work to improve that. What is going well? Well, hardware is actually performing relatively well. Dick's Sporting Goods started offering Peloton's equipment, and year over year, that third-party sales channel is up 74%. There was some questions about this on the conference call, and the way to think about this from a margin perspective is Peloton is going to make less margin on each bike that's sold through Dick's or Amazon, but they're going to spend less on marketing because that marketing spend is going to go to those companies. On a net basis, it's going to be about equal as if you bought it from Peloton yourself. So any sort of growth from a hardware perspective is good news, and Peloton ultimately makes its money through the digital app or the connected fitness app if you're buying hardware. The bike rental model continues to also perform relatively well. Again, talked about that quite a bit. Said that it was about an 18-month payback period, and revenue is up 100%. One of the challenges with the rental business is you're spending the money up front to either build or buy the bike. Some of these are refurbished. And then your payback is over the course of multiple years in the future. So from a free cash flow perspective, as the bike rental business grows, free cash flow actually gets worse, even if your profitability long-term improves. So that's something to keep in mind as we look at the guidance in just a little bit. And then there's also strong demand for the Tread Plus product that was introduced in, I believe, the fourth calendar quarter. And the treadmill is going to be an interesting product for Peloton because there's a lot more competition in the market than there is for bikes, but it's about a 2x market. They highlight that here. The treadmill market is about twice the size of the stationary bike market. So could potentially be a big market for Peloton, but you got to kind of get there. You got to build that trust in that community. They're doing some things with content like marathon training and more high intensity training for kind of higher end athletes. So that could be another catalyst. But again, we haven't really seen evidence that that is going to drive the business in the future. So let's get to some of the numbers. And this is usually where I start reading their quarterly report, because this gives the member numbers, 6.4 million, connected fitness subscriptions. That was up 1%, so up slightly. But these have kind of bounced around in the same general area, and I'll get to guidance in a second, but they're expecting this to go up in the next quarter and then actually fall in the fiscal fourth quarter. So I'm not seeing a lot of growth momentum here, and this is really where you would like to see growth, is in this number and then also in the paid app subscribers. So 718,000. They made the transition to a new app model in mid-2023. And it really sounded on the conference call like they were kind of learning their way through how to launch that, how to market it. They were surprised with the uptake of people paying for the app. They started advertising this as a free app, thinking that you grow that top of the funnel. You want that funnel to be as big as possible. And then you get people to upgrade in the future. People just went straight to paying $12 to $25 a month for it. So changes the ways that you might market that product a little bit, but they're not having a lot of momentum, and churn is still really high. This is not all that surprising, because you don't have a lot of information about how long people are going to actually stay with the app. And a lot of people are going to cancel in those first couple of months. So you try something out for a month, maybe two, and then you cancel. That's why this is 7.2%. I would expect that to come down over time, but we haven't seen that quite yet. From a financial perspective, there's two things to look at with Peloton. One is the hardware. That is what they call connected fitness product revenue. That was up 77% quarter over quarter, but down 16% year over year. The good news is there's actually a gross profit in hardware. And what you want to see from Peloton is even just a small gross profit in hardware. You'd love to be more like 5 to 10% gross margin, but just the fact that it's positive is moving in the right direction. Right now, the gross margin is 4.3%. Where the money is made is in subscription revenue. And subscription gross profit was up 2%. Revenue was up 2%. Those are both quarter over quarter numbers. And then gross margin is really, really high. Subscription contribution margin, almost 72%. And that's staying consistent. And that's why you get your total gross profit increasing 27% year over year, despite the fact that revenue was actually down 6%. So this is why you want Peloton to be an app company and a software company, subscription company, and not a hardware company. They're not going to make a ton of money on hardware. They're going to make it that long term as people pay to use that app for years upon years. That's where the ultimate value lies. But you still, after some increased marketing costs, have a loss for the quarter. $194.9 million loss, adjusted EBITDA loss of $82 million. And here's this cash flow number, $37.2 million in negative free cash flow. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. The final thing I want to look at is guidance, and this is the second quarter fiscal 2024 numbers. That is the quarter that was just announced. They're in a little bit of a strange quarterly year. They're expecting a third quarter connected fitness subscribers to increase about 2% quarter over quarter. So that looks like you're on a good path, but I'll pour some cold water on that in just a second, because you're actually having a pretty solid time of the year. It's pretty cold in big parts of North America and Europe. And so that's when you see your subscribers go up, and then they go down in the summer. Ending paid app subscribers starting to move in the right direction. This is starting to be positive, at least on a guidance basis. So we'll see if they're able to execute on that, maybe even improve on that a little bit. But this is where, if they get growth really picking up in the app subscriptions, that's where the upside is going to be for the stock. Revenue down slightly. That's mostly because they're going to be selling less hardware, and that's why you see the increase in margins. So margins are going up because the mix is going to be more towards subscriptions rather than hardware. And adjusted EBITDA is expected to be negative again next quarter. For the full year, and this is ending paid subscriptions, 3 million. So like I said, flat from last quarter. The bump that you're going to expect to see in the fiscal third quarter is going to kind of fall away as you get into these summer months. And app subscription subscribers and the app subscribers also falling. This is a pretty big range. And the reason it's a big range is they just simply don't have a lot of information about what customers are going to do with the app when we get to kind of these summer months. So it's relatively simple to cancel. Maybe they just kind of go in and out on a month-to-month basis. And this is where adjusted EBITDA, again, expected to be negative for the year. So all in all, not the best quarter for Peloton, also not the worst. I'm a little surprised that the stock is down as much as it is. But at this point, if they're not going to get to free cash flow positive, then you start to get worried about the balance sheet. And there's about $1 billion of net debt on the balance sheet. And that's really what is concerning for investors, is eventually you have to refinance that debt. And if you're not a profitable company, if you're not generating positive free cash flow, it becomes much harder and much more costly to do that. Now, I think that management is making the right moves in moving towards the app. You want to be growing that high margin subscription segment, but they're also learning sort of on the fly as more and more people are going back to gyms. They're spending less time and money working out at home, and they're trying to figure out how to market this new product. And they clearly don't have all of the answers yet. And the fundamental question that I have as an investor is this market big enough to really care about? I think that Peloton can be the leader in at-home fitness. I've been using their products for quite a while. I think there's phenomenal improvements just in the app, even in the last 6 months or year. But is there 3 or 4 million people that care about that, like you see right now with Peloton, or is there 10 or 15 million? That's where the upside is in the stock, is if the market is 2, 3, 10 times bigger than we're seeing today. And we're not seeing that in the numbers yet. So that's, I think, the reason that the stock is down. That's why I'm not buying more, is until we see that inflection point. You see Peloton move towards growth in both its subscribers and then the subscriber revenue, more than just kind of 1 or 2 percentage points a quarter. The stock's going to be kind of bouncing around until we get to that point, and we're not quite there yet. So mixed bag for Peloton, but what did you think about the quarter? Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.